Welcome back. You're watching Power Breakfast on CNBC TV 18. And another key decision, the RBI announced that starting April, retail loans will be linked to an external benchmark and not the current marginal cost of funds based lending rate, also known as the MCLR. Ritu Singh is here to explain what this means for consumers.
That's right. RBI has asked all lenders to link all the new floating rate loans to external benchmarks in a bid to improve transparency. So starting the 1st of April next year, floating rates personal or retail loans as well as loans to small businesses will have to be linked to an external benchmark. However, banks will have the discretion to decide on the spread at the time of inception of the loan. That should, RBI says, remain constant over the entire period of the loan unless there is a change in the borrower's credit score. So the external benchmarks that banks can choose from include RBI's repo rate or the 91 or 182-day T-bills or any other benchmark market interest rate that is produced by FPIL. Banks will also be free to offer such loans to other types of borrowers if they so wish. The final guidelines are expected to be released by the end of the month. So what will be the impact of this move? Yes, it will bring more transparency in loan pricing and better transmission of benefits to the customers. But for banks, this could also mean more volatility when it comes to their profitability.
Okay, Ritu, thank you for breaking down that for us. But let's now go across to Abhishek, who will tell us what brokerages are making of MPC's decisions yesterday.
Good morning, Anisha. So to begin with, brokerages have a mixed view, more on the positive side. Deutsche Bank says that RBI policy was largely positive for the banking sector. They mentioned that the SLR reduction is very good for banks with lower excess SLR. So the likes of Yes Bank, SDFC Bank, Federal Bank and ICICI Bank is the key beneficiary that Deutsche Bank feels on account of the cut in SLR. RBI seemed comfortable with regard to the improving liquidity situation, which we have seen that RBI did mention that they will act as lender of last resort for NBFCs. However, that is not warranted as of now, and RBI is comfortable with the liquidity situation. Morgan Stanley says that I expect inflation to remain benign, especially for the next two readings. Expect rates to be unchanged in the next two policy reviews. However, they expect that there is a high chance of probability of RBI, turning to neutral in their next policy. Back to you.
All right, Abhishek, thanks a lot for that. Let's also hear out what economists and bankers have to say on the RBI status quo policy and what will RBI do in 2019.
I'm not really expecting a cut into February, but at least I'm expecting that the stance will change back to neutral in the February meeting. I think the cut will depend. I know that the RBI has vociferously denied that it reacts to external conditions. But like any other central banker, they will need to be very aware of what happens in February, how the global market reprices Fed funds rate hikes, and what happens to the 10-year U.S. Treasury. I think global financial conditions will matter, but if those remain broadly stable, I think the first thing that they would do is to move the stance away from tightening to neutrality.
As far as the OMOs go, I would say this is the upper end of what most people would have expected in the market. One would have expected the RBI to slow down in the fourth quarter at least. I think the indication they are giving is that they are not willing to tolerate any core liquidity deficit, that is liquidity, system liquidity adjusted for government balances. So by doing say another 40,000 per month, that is 1.2 trillion in the fourth quarter, I think core liquidity will come closer to zero by end of March. I think that's what the RBI is aiming at. And obviously that is extremely positive for the bond market. Now as far as the rate cut, we are not expecting anything. In fact, we think a prolonged pause is the most likely scenario. But I would say if you ask me about the risk, I think the risk is in terms of rate cuts happening at some point. If not in February, then by April.
It's not only the cut here. First of all, I think though today's policy didn't change the stance, but the other factors which were regarding the OMOs and the statement by the governor regarding what can open up. Markets have already started factoring in a cut, maybe February, maybe April, but yes, if you look at the curves, it's already pricing in something now that is the next move rather than a hike which was anticipated till last policy.
So basically at present we are not seeing any possibility of a rate cut, but I think if the inflation continue to be at the the projections which have been given by Reserve Bank, and if the credit growth slows down, then I think maybe going forward there is a possibility of a rate cut.
We see growth slowing to below 7% by the Jan-March quarter, but again, when we say slowing, we're only talking about a 20-30 basis point slowdown from the current trajectory. That would not warrant any major reassessment of the output gap or the likelihood of economic trajectory having a bearing on the inflation forecast. So from that perspective, I think the pause for the prolonged period may be warranted, but just like oil has crashed in the last couple of months, it can very easily resurge. And I think this is what the sort of insurance policy, if you will, that the RBI would like to hold on without sounding extra dovish.